The content presented in this podcast is intended solely for general informational and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this podcast without seeking the advice of a qualified financial professional. This audio/video podcast is an AI-generated product produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analyses expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. Copyright Reflections of Reality. All original content rights reserved. All right, welcome to this explainer of the Convergence brief. We have an absolutely fascinating synthesis to unpack today. It's completely derived from our two source reports, the Polymarket Macro Monitor and the Weekly Market Intelligence Brief. So let's jump right in.
Okay, so right out of the gate, we're looking at a massive consensus gap in how geopolitical risk is currently being priced. Think about it like this. On one side, you've got legacy sell-side consensus models. They're treating Middle East stability as the baseline, basically pricing in a less than 10% tail scenario for major conflict. But then, on the exact opposite side, crowdsourced probability markets, specifically Polymarket, are assigning a staggering 27.5% risk of a U.S. invasion of Iran. That is a massive, massive divergence. And it basically tells us that energy volatility is completely underpriced by the legacy models.
So how exactly do we resolve this gap? Well, here is our roadmap for today. We're going to strictly cross-reference two independent data sources. We'll start with 1, the consensus gap, followed by 2, the convergence methodology. Then we'll analyze 3, Lens 1, Polymarket, and 4, Lens 2, tape signals. Finally, we'll arrive at 5, the convergence verdict, and wrap it all up with 6, swing implications.
Starting off with Section 1, the consensus gap.
This right here is the fundamental question driving our whole analysis today. What actually happens when crowdsourced geopolitical probabilities totally clash with actual institutional money flows? How do we navigate that friction between predicted external risks and what the current market tape is literally doing right now?
Moving right along to Section 2, the convergence methodology.
To solve this, the convergence brief relies strictly on comparing two completely independent lenses. Lens 1 is the forward-looking Polymarket Macro Monitor, which feeds us market-based event probabilities. Lens 2 is the Weekly Market Intelligence Brief, or the Weekly Report, which acts as our flow and breath machinery, tracking market sentiment and capital flows. By synthesizing these two together through comparative analysis, we can strip away all the noise and find out exactly where the signals overlap.
Next up, Section 3, Lens 1, looking at the Polymarket odds. Let's break down the probabilities from our first witness. We have that alarming 27.5% chance that the U.S. invades Iran before 2027. Next to that, there's only a 12.5% probability that Strait of Hormuz traffic returns to normal by August 31st. Together, that signifies a very real structural bid for crude and gold. Then, flipping over to the monetary policy side, look at this. There is a deliberately anchored 0.1% chance of a 50-plus basis point Fed cut in July, basically zero. The market has completely priced out a dovish surprise, which strongly signals a higher-for-longer regime.
Now, beyond the Middle East and the Fed, Polymarket is also highlighting some acute systemic and election risks. For instance, there's a 76.5% probability that NVIDIA remains the largest market cap by the end of July. And sure, while that supports momentum, it absolutely highlights a live fragility and concentration risk. Looking way ahead to the 2028 elections, we're seeing a 19.9% probability for J.D. Vance, which points to a protectionism premium in long-term USD strength, alongside a 19.8% probability for Gavin Newsom, bringing potential progressive tech and energy regulation risks.
All right, moving to Section 4, Lens 2, the tape signals.
Before we look at the raw data here, we have to anchor ourselves to the exact structural definition of our first tape indicator, the MVI, or Market Valuation Index, measures how attractive stocks are versus bonds after adjusting for the business cycle. So it's showing us the cyclical equity risk premium, not just raw valuation. High or positive readings mean stocks are cheap and rewarding relative to yields. Deep negative readings, that means they are expensive and risky relative to yields.
And this perfectly illustrates where we are today. As of July 24, 2026, the SPY sits at negative 0.39 and the QQQ at negative 0.40, indicating large caps are slightly expensive. But the really crucial point here is the IWM, representing small caps. It's sitting at a deep negative 1.06. This tells us small caps are heavily discounted, yet they are still lagging, which is a classic risk-off breath signal.
Our next metric is the MDI, or Market Dashboard Index. Structurally, this simply measures overall market sentiment, where a reading between 10 and 35 would indicate bullish mean reversion. So what is the tape actually telling us right now? Well, the MDI currently sits at 4850, having fallen 4.13 on the week. This places the market squarely into the bearish kickoff zone. You know what happens in this zone: volatility is rising, rallies are being sold, and the risk-reward for taking on new long positions is just unfavorable. Our final critical definition here is health. This metric evaluates market breadth based on a machine learning flow model. A high reading indicates broad trend confirmation, while a low reading flags divergence risk. Look at this stark divergence we are seeing in the medium term. Price is holding near its highs, but the health percentage is structurally weak, at just 45.10%. It's improving, slightly, sure, but it remains strictly under 50. So we have above 50 positioning, but sub 50 breadth. The source material accurately calls this the health versus price paradox.
All right, Section 5, the Convergence Verdict.
This is the big moment. We cross-examine both of our independent witnesses, and the verdict is absolutely striking. On the energy risk premium, Polymarket's invasion probabilities align directly with the tape showing no panic washout in energy. They both agree on an energy and gold overweight. Regarding equity multiple cap, Polymarket's geopolitical cluster and Fed on hold thesis align perfectly with the tape's bearish kickoff zone and sold rallies. They both agree equity risk-reward is unfavorable. And finally, for USD strength, Polymarket's protectionist odds match the tape showing USDP in accumulation. They both agree the US dollar is structurally supported. But it is equally important to highlight where the framework does not force a verdict. Both lenses are completely silent on the Goldilocks regime and Taiwan/AI reordering. The tape essentially says wait for a signature, and the strategic risks here are not yet measurable. As the brief explicitly notes, this gap is the trade itself, not just background noise. Let's move to our final section, Section 6, Strategic Swing Implications. Before we look at positioning, we must ground ourselves in the strict structural definitions of the portfolio rotation map. Accumulation means active institutional buying. Rotation in means improving momentum. Rotation out means fading momentum. And finally, liquidation equates to institutional selling. Applying those exact definitions, we see the dominant market mode right now is rotation out at 16.80%. This confirms profit-taking is the primary institutional mode. But look closely at what is actually experiencing accumulation. XLB for materials, XLU for utilities, and UUT for the US dollar. On the flip side, we see liquidation in assets like IEF for long bonds and DIA. This institutional map is already, literally, pricing in the geopolitical risk premium. So, what is the actionable output for the swing book? The strict rules of engagement right now dictate letting insulated winners like LLY and JPM breathe. For held names that are stopped out, a 100% cash posture is strictly recommended. Remember, this is a deliberate strategy, not a failure. You only deploy fresh capital where both lenses completely agree, meaning energy, gold, and the USD. We'll wrap up this explainer with the defining tension of the current tape. Will market breadth finally catch up to the Goldilocks mirage, or will price ultimately concede to the heavy geopolitical premium currently being priced in by prediction markets? Thank you so much for walking through this structured analysis with me today.